and two of those names are Zomato and Swiggy. Of course, Zomato seeing the post-earnings reaction in yesterday's session and Swiggy bearing the brunt of that as well. Mangalam, you have more data on that.
Well, just three things that really stood out from Zomato's commentary yesterday. The numbers not particularly bad. I mean, you did see an EBITDA decline and all of that and stuff, but three things from the management's comments that, spooked the street. The first one, of course, was on Blinkit, where they believe that losses will continue in the near term. This is a marked difference from what they had said a couple of quarters ago, where they are turning operational profit. So as a result of which they've brought forward their investments. Heightened quick commerce competition has led to a temporary pause in margin expansion. Most on the street were hoping for this growth to continue and then operating leverage to kick in as well. But now that margin expansion has been paused, and food delivery revenue, which was good from an operational standpoint, grew just 2% from a GOV basis quarter on quarter. That slowdown is largely because of the consumer sentiment weakness that we are seeing. As a result of which, brokerages have cut their target as well. Jefferies is a hold rating and a target cut from 275 to 255. They believe that aggressive Q-commerce expansion may force competition to follow suit and entry of new players to further add competition as well. CLSA, while they have a positive rating on the stock, high conviction outperform, they've cut their FY25-26 EPS estimates by 25 to 34% to reflect faster store rollout. And for FY27, they've raised the EPS forecast because the throughput would have increased as well. Nomura, they have a buy rating, 290 rupee target price. They're saying that strong execution and balance sheet are key positives in favor of Blinkit, but it is a good opportunity to accumulate given large TAM and likely market consolidation as per Bernstein. That's about Zomato. Now, if you look at both the intraday charts of Swiggy and Zomato, you would see that once Zomato fell, Swiggy felt the heat as well. So if you look at the intraday charts, side by side, Zomato recovered from the lows, Swiggy is still recovering from the lows. Why is this important? Because Zomato's weak performance, weak commentary around quick commerce has impacted Swiggy. Secondly, since Swiggy's IPO, the valuation gap between the two has narrowed. So if you look at just, the Swiggy and Zomato valuation discount itself, Swiggy, when it came out of the IPO, issue price at 390 rupees, the peak, the discount versus Zomato's valuation was 65%. At peak, that discount has actually narrowed to almost 32 to 35%, depending on the multiple that you are giving to it. And now the discount between Swiggy and Zomato is around 50%. So at what rate does this settle is another variable that we'll be looking at. When Swiggy was offered at IPO price, the discount versus Zomato's valuation, 65. Then Swiggy moved higher, Zomato moved lower. Swiggy was at one point above 600 rupees per share as well. That time, the discount between Swiggy and Zomato was close to around 35% itself. And now, Swiggy too has fallen off highs, Zomato has fallen as well. The discount has widened once again to 50%.
The other similarity is the fact that Swiggy's post-listing high, as you mentioned, 617 rupees. The stock is off 30% from that. Zomato's high, 304 at the day's low. That too is down 30% from its peak. So both of them moving in tandem is Zomato and Swiggy bearing the brunt of the results. Now, the other